Staying with us on Point, Asian shares tumbled on Tuesday after Wall Street hit a confirmed bear market milestone and bond yields struck a two-decade high on fears that aggressive U.S. interest rate hikes would push the world's largest economy into recession. The Nikkei falling 1.3% in Hong Kong, the Hang Seng Index slipping 0.1%, and in China, the Shanghai just 1% firmer. Let's go to the United States now, where equities tumbled on Monday, with the S&P 500 confirming its inner bear market, heightening fears that the expected aggressive interest rate hikes by the Federal Reserve could push the economy into a recession.
The Dow fell almost 2.8%, the S&P shed nearly 3.9%, and the Nasdaq dropped nearly a stunning 4.7%. The benchmark S&P has fallen for 4 straight sessions and is now down more than 20% from its most recent record closing high. Zach Hill, head of portfolio management at Horizon Investments, says this bear market is likely to stick around a while.
Really simply, the S&P 500 has entered a bear market because the Fed wants it to. We've been talking about don't fight the Fed, and that's been the ethos for investors since the global financial crisis, really. And in 2022, when inflation is the #1 issue, don't fight the Fed means tighter financial conditions, which means lower equity valuations, wider credit spreads, and a stronger dollar. So we've seen all those so far this year, and until we see inflation start to come under control, we think it likely continues.
The longest bear market ever for the S&P lasted just over 5 years, while the shortest lasted just over a month, according to S&P Dow Jones indices. On Monday, high-growth heavyweights such as Apple, Microsoft, and Amazon were the biggest drags on the market, as the yield on the benchmark 10-year U.S. Treasury note hit 3.44%, its highest level since April of 2011. Growth stocks are more likely to see their earnings suffer in a rising rate environment. A hotter-than-expected consumer price index reading late last week prompted traders to brace for steeper interest rate hikes from the Fed, which is scheduled to make its next policy announcement on Wednesday.
European stocks tumbled to 3-month lows yesterday. Eurozone banks dropped 2.8% on disappointment that the ECB did not reveal any tool to support peripheral bonds at its meeting last week. France's biggest banks, such as BNP Paribas, Societe Generale and Credit Agricole, fell between 2.7% and 3.8%. Let's take a look at the European and other markets now. Get some analysis on what's taking place in the markets. Makwe Masilela joins me now from Makwe Fund Managers. A very good afternoon, Makwe. I'm even scared of asking what's happening with the markets, but let's start in South Africa. The JSE closing in the red yesterday, falling over 2%, and we saw a bit of green this morning. What's happening now?
Good day to you and to the viewers. Unfortunately, the meltdown is continuing. That relief that we saw in the earlier session has faded away, and it's because people are worried that the central bankers, meaning policymakers, they seem to be panicking. That is why people are starting to think that the guys, instead of increasing interest rates by 0.5%, they might start considering increasing interest rates by 0.7%, 0.75%, as we've seen that initially were used to the 0.25. But it's a question of people are worried that if you continue to increase interest rates rapidly, then that definitely is going to dent your economy, and hence you hear people talking about the possibility of a recession.
We're seeing the S&P 500 down over 20% year to date. Just talk to me more about what's leading to the Nasdaq, Dow and S&P closing down. I know you've just touched on it briefly as well.
You know, it's more a reversal of, if you realize, the stocks that managed to benefit during the pandemic, which were going up, IT stocks, stuff like that, because demand was high. These are the ones that have been losers when we realize the downturn this year. And only because we know that higher valuation gets to be weighted down by rising interest rates, meaning your future earnings gets to be less when we think that interest rates will go down. Interest rates will start going up. So those companies are the ones which are mainly going down because people are worried that interest rates are going to start weighing on our valuations. And as we know that you also have debt, and if those companies have huge debt, then it means it becomes more expensive for them to repay that particular debt because interest rates were high. And also remember, the yield curve inverted briefly yesterday, so that also exacerbated the panic that we see today in the market.
Okay, so I'm assuming what's happening in the US, Euro and SA markets, the Asian markets are going to track what's happening in the US markets. And of course, those fears about a recession becoming more pronounced and much more of a reality.
Exactly. In Asia, basically what they did this morning, they were catching up of what happened to us yesterday during the day and what happened overnight in the US. So hence we saw that even the likes of Australia, which was closed on Monday, being down almost 3.5%. So it's a question of catching up. And also don't forget the issue with China itself, that on Sunday, Beijing, they discovered another COVID-19 variant or a more ferocious COVID-19 cases, and then that led to some of the closing of the city.
Okay. Let's come back to South Africa. The rand passing that 16 rand to the dollar mark. What does that mean practically for us in South Africa and on our cost of living in our day-to-day lives?
Basically, as a net importer, it means we will be importing inflation because whatever we are buying overseas gets to be priced in dollars. So our cost of living will continue to go up, meaning consumer inflation will continue to rise. And then the Reserve Bank don't have much of a choice to start looking to increase interest rates by 0.25%. They'll probably continue with a 0.5% increase with the whole idea of trying to fight or tame inflation. And as we know, when interest rates go up, it means we'll be left with less money to spend on other things. So now the economy doesn't have that spending that will be required. And remember that our economy is more than 60% driven by consumer demand.
Mm-hmm. Let's take a quick look at company news before we go. We'll start with Telkom. They results for the year ended March 31. Revenue down 1.1% to 42.8 billion rand. What are the other highlights from there?
And that revenue, we know that it was boosted by the mobile business, but unfortunately, when it comes to fixed and IT businesses, they continue to decline as people are moving to more modernized technology, like fiber and LTE. But their headline earnings per share is up 2.5%, but also because of lower finance charges and fair value movements. So the business continued to be under pressure, but the guys managed to increase their mobile subscribers by 10.5% to 16.9 million. So that's good. And also OpenServe seems to be moving away from making losses, because even if you look into the fiber to home connectivity rate is sitting at almost 46.5%, and almost half of their revenue is coming from your business.
All right, and Standard Bank releasing a voluntary trading update for 5 months to 31 May and trading statement for the 6-month period ending 30 June 2022. What are the highlights from that?
Basically, Standard Bank is accepting that since the release of their results, things have changed, and then changed in a very negative way. If you look, whether it's coming from banking fees, though they increased, but very low. If you look at the likes of their net interest income, it's going up. And then, but if you compare with the previous period, it's only at a small margin. And that tells you that, yes, as much as they might be growing and expect headline earnings per share to grow by more than 20%, the economic situation has changed for them.
Makwe Masilela from Makwe Fund Managers, thanks so much for your time and insight on SABC News this afternoon. Always a pleasure speaking to you. It's time for a short break. When we come back, my colleague Nompumelelo Siziba standing by with more business news and speaking to the Managing Director at the World Economic Forum, among other things. It's good afternoon from me. Stay safe.